Hello,
Good morning.
everybody, and thank you for joining us this morning. My name is Roy Deaver. I'm an international tax partner with Moss Adams in our Seattle office.
And I'm Ken Harvey. I'm also an international tax partner based in San Francisco.
And today we'd like to talk to you about the international tax items within the new tax bill. So here's our agenda for today. So we have a little bit more time than what we've had on previous webcasts, where we've only had about 10 or 15 minutes to cover some of the broad changes to the international tax landscape that will be taking effect both in 2017 and 2018 and in future years. So, many people have talked about this bill being the biggest change in tax law since 1986. And while I'm not necessarily going to dispute that, at least on the international side, this is a much bigger fundamental change, especially for those companies and taxpayers that own foreign entities. And this is really the biggest change in that area since 1962. So what we're really talking about is basically a once-in-a-lifetime change in tax law and tax policy.
I've been working in tax since almost the 1986 Tax Reform Act, and this is by far the biggest change I've seen. And as Pocahontas used to sing, it's a whole new world. Although I think we will, of course, adapt, and the more things change, the more they stay the same. So over time, we'll all get used to the new system, but there are very fundamental changes afoot.
And so before we get into that, we do have an introductory video that we will show you and give you some information on the webcast.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement, or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Okay. So as we mentioned, we have a pretty full agenda that we're going to try and get through in this hour. And if you have any questions as we're moving through things, please feel free to use the Q&A button to send those along. So the first thing that we're going to talk about is the Section 965 transition tax. Kind of under the old law or under old regime, earnings from a foreign entity were deferred until those were repatriated, and then there was a foreign tax credit, at least for C corporations, to mitigate the double tax burden on those foreign earnings. But under the new law, there's now an exemption system, which we'll talk about in a little bit, on those dividends. But in order to pay for this change in the new law, Congress introduced a one-time tax on the unrepatriated earnings. Unlike most of the provisions of the Tax Act, which take effect in 2018, this rule will generally apply to taxpayers on their 2017 tax returns, with some potential for some effects in 2018 as well. So even though the dividend exclusion rules are only going to be applicable to C corporations, the toll tax paying for that exclusion applies to all taxpayers that own either a controlled foreign corporation or any U.S. person that owns at least 10% of a foreign corporation where at least one of the shareholders is a domestic corp. So first thing, a couple definitions within there. There's been no guidance on what a domestic corporation is, whether that includes an S corporation or not. And then second, when we're talking about controlled foreign corporations, that's any foreign entity where there's greater than 50% U.S. ownership if you were only to count 10% owners. And so for this purpose, the accumulated earnings that are going to be subject to tax is going to be the greater of two amounts, either as of November 2nd, 2017, or for calendar year taxpayers, the foreign earnings of that earnings of that foreign entity at its year end 12/31/17. So what's subject to tax is is earnings accumulated since 1986, and it's these earnings of these entities as measured under U.S. tax principles, not their book retained earnings. If some of that income had already been subject to tax in prior years through the Subpart F system in the U.S., then they're not going to be subject to tax again under the toll tax. There's also some special rules. So if the foreign entity actually paid a dividend during the year to the U.S. shareholder, there's some special rules that take that into account. So the main thing is because this is being treated as a category of Subpart F income, which are the U.S.'s anti-deferral rules, the effect of what actually happened during the year is not going to be as straightforward because there's an ordering rule when you have both Subpart F and actual dividends that the Subpart F occurs first. So even though a dividend may have been paid during the year, you may still have a toll tax amount on that income. In measuring the earnings and profits, a taxpayer can use any foreign corporation that has accumulated losses to offset entities with accumulated income. So effectively, you're paying on the net aggregate amount of earnings that have been deferred offshore. And then also to the extent that a corporation has a net accumulated loss after doing all the aggregation, and that there are other U.S. companies within the same affiliated tax group, that loss can be shared to some of the other companies within that tax group.
And Roy, I assume that all U.S. shareholders of foreign corporations have really well-maintained earnings and profits computations as well as tax pool information. So there probably won't be a lot of work involved in getting this number computed. And of course, I'm being facetious, but it's a kind of not a great Christmas present from Congress to the corporations of America in terms of the work that needs to be done to document all this.
Yeah, I mean, for a lot of taxpayers, there's not been a massive effort to maintain accurate E&P and tax pool information, especially if they've not had dividends in the past where that information would have been more relevant. So it is an exercise that will need to be thought through in terms of what the amount of toll tax is going to be. Again, especially because the amount of the inclusion is based off of those earnings as computed under U.S. tax principles. So as if that foreign entity were a U.S. corporation and not a foreign entity that's paying tax and calculating its taxable income in its own home country.
Yep.
So under the 965, the main discussion about this section is that there are two tax rates that are going to apply depending on the assets of the specified foreign corporation. That's either a 15.5% rate or an 8% rate, depending on what the assets outside of the U.S. are, whether those are in liquid assets or illiquid assets, with liquid assets carrying the higher of the two tax rates. However, it's not as simple as applying these tax rates to the amount of income, that is invested in those assets. This gets to how the law was written and how it's being implemented. What ends up happening is a taxpayer includes the gross amount of income, so the gross amount of earnings, but then computes a deduction which is based on the rate that the earnings are subject to tax, again, the 15.5 or 8%, and then takes a ratio of that rate to 35% to arrive at the net income. And again, 35% was chosen because it's the highest rate applicable to corporations. You'll find in a lot that we talk about today that most of the international tax rule changes were written specifically for C corporations with some potentially ancillary negative effects to individual taxpayers, individuals that either own foreign entities or have foreign operations that they're holding directly or they're holding through pass-through entities.
And I think what that means, among other things, is the inclusion computation, whether it's cash or non-cash, is the same whether you're an individual or a corporation, even though the computation is supposedly to get to a 15.5% corporate tax rate.
That's exactly right. I mean, if you're paying tax at something other than the 35%, so for example, an individual who's in the top 39.6% tax bracket, they're actually going to pay more than those targeted effective tax rates of 15.5 and 8%. Now, while there's an election that's available for an individual to mitigate this effect, this is something that could have other ancillary effects that need to be discussed with your tax advisor to make sure that you're understanding the overall effects of the election. In terms of the tax, the tax is then, or the income is calculated, and in terms of what is the actual total tax, there's two separate computations that need to be done with the 2017 tax return. There's a with and a without computation. So taxable income is computed with the amounts included, and then there's a separate computation as if you were to exclude those amounts. And the difference between those two amounts is what is going to be the Section 965 toll tax that in total is going to be due. Then at that point, a taxpayer has the option to pay that tax in installments over an 8-year period, with those payments being backloaded into the last 3 years. Now, if you're an S corporation shareholder and you will have a toll tax due, you actually even have a further election that you can make, which is you can defer to when those payments will even start. An S corporation shareholder has the option to not even start paying the tax until a point in time in which there is one of the enumerated triggering events. And those are either the S corporation shareholder sells their shares, the S corporation itself sells substantially all of its assets, or the S corporation is no longer an S corporation. So there are some abilities for, at least for those individuals, to have a little bit of a benefit on this.
And somebody in Congress must really like S corporations, because that's a really nice benefit that they get that nobody else seems to have.
Correct. I mean, it's the difference between, even though an S corporation shareholder and an individual LLC owner will be taxed similarly, this deferral opportunity is only available to those S corporation shareholders.
And potentially indefinite.
Correct. So if a C corporation can use any underlying taxes that have been paid by those foreign entities, they're able to take that as a foreign tax credit against the toll tax. But it's only the foreign tax credits applicable to this deemed inclusion. Any foreign tax credit carry forwards would not otherwise be available to offset the tax in the year. But the other side is, because there's not a full inclusion of that income, because we're computing that deduction that I just talked about, there's also a haircut on the foreign tax credit by the same percentage as the deduction. And then the amount that's included is treated like any other type of foreign source income in the year, which means that if there's any overall foreign loss or overall domestic loss that the taxpayer has, those need to be recaptured as appropriate under just general U.S. tax principles. And those will affect kind of the net tax liability that's computed in the with and without computation to figure out the overall amount of the Section 965 tax.
And Roy, it's not in the slides, but because part of the tax reform, they're getting rid of Section 902 indirect credits. They'll still have 960, but in a sense, this is the last hurrah for a corporate taxpayer to use many of their foreign tax credits.
That's right, especially the accumulated, and the way that Section 960 is being modified, which is the foreign tax credit that attaches to any Subpart F income. The Section 960 is being modified so that's no longer based on your pool of historic taxes that have been paid, but rather only attributable to the taxes paid within the year by that foreign entity. So you're right. This is kind of the last bite at the apple with respect to any accumulated foreign taxes that have been paid over, again, since 1980, or either since the founding of that foreign entity or to 1986, whichever is most recent. To the extent that a domestic corporation inverts within 10 years from the enactment of the statute, then you lose the ability to take the 15.5 and 8% tax rates, and rather all of that deferred income is now going to be subject to 35%. So again, this is just another way for Congress to prevent corporate inversions, which have been quite the rage and in the news quite a bit over the last few years. And any attempts that they've made at trying to stem that tide have worked for a little bit until someone finds a way around it. And so again, this is kind of another way for them to try to stop that. Also, a taxpayer can elect to not use any net operating loss deduction against the inclusion. So again, the default position is that NOLs can or will offset that income. A taxpayer needs to analyze the cost of using their NOL or paying any tax and preserving the tax attributes to figure out whether or not this election is going to make sense. There is no guidance yet on whether any current year losses can be used to offset the inclusion, but again, because the computation is a with and a without computation, it seems that it's inferred that a current year loss can offset that amount, but until we see some guidance on that, we're not particularly certain that that is the case. So, Ken alluded to it a little bit in terms of, the computation of earnings and profits and tax pools. What we're kind of seeing overall is really an 8-step process. And while these seem to be fairly simple steps that we're noting, these are just, again, kind of high-level steps. And there's really more analysis and detail that's going to go into each one of these in figuring it out, what that amount of 965 toll tax is going to be. And additionally, there are several open items under each of these as well in terms of just additional information that's going to be needed to be issued by the Treasury Department to provide some guidance on these matters. So the first thing is identifying which of the foreign entities that this is going to apply to. So again, it's either any controlled foreign corporation, or if it's 10% owned. So and if it's 10% owned, then you need at least one corporate shareholder in there for that to be added to your list of companies where this is going to apply. Then the amount of earnings and profits, either a positive or deficits, are computed. We figure out the pro rata share, so your ownership percentage multiplied by the amount of earnings. Then that gets reduced by the aggregate amount of deficits. Then it's figuring out what is the aggregate cash position of each entity. And so again, there's some definitions as to what is considered cash. It's really cash, kind of liquid investments, and net accounts receivable. So that is an item that's going to get factored into the 15.5% tax rate. And the amount, again, is the aggregate amount for the foreign entities. And it's based on either their cash or liquid asset position as of the year end. So for calendar year taxpayers, again, that's 12/31/17, or the average over the prior 2 year ends. And again, you take the greater of those two amounts. Then for C corporation shareholders and individuals who make the election to be taxed at corporate rates, you would be able to use foreign tax credits, as we discussed, to offset the tax. Then if there's NOL carryforwards, need to analyze whether or not we're going to use those NOL carryforwards to offset the income inclusion. And then finally, calculating the 2017 taxes both with and without the inclusion to figure out what is the 965 total tax. And so just a quick example of this tax calculation. So let's say we have two 100% owned CFCs, one with positive earnings and profits of $1,800 and one with negative of $300. Note that when you are using your deficits, you can only use the deficit that existed as of November 2nd. So if you had a larger deficit as of 12/31, that cannot be used. Or if you had positive E&P as of 11/2 and a deficit at 12/31, you lose that deficit and you include the positive E&P at November 2nd. But in this case, just to keep it simple. I'm sorry. Go ahead, Ken.
I was going to say, presumably Congress is afraid that we're all going to take big write-offs in our CFCs after the date that the bill was introduced in Congress.
That's right. And so for this case, just to keep it simple, we just have the same $300 deficit, both at November 2nd and 12/31. So our a greater amount of accumulated deferred foreign income is $1,800. We get to reduce it by the $300 deficit. So we're including $1,500 in the U.S. return, and again, that's our gross inclusion. For the foreign entities, in total, they have $1,400 of cash, and again, we're just assuming that this is the highest of the two amounts. We didn't provide all the detail as to the current year end or the average of the prior two. But we have $1,400 of cash. So of our $1,500 inclusion, we have $1,400 that's going to be at the higher rate of the 15.5%, and in order to get to that, we have a deduction of $780. Our remaining $100 inclusion is attributable to illiquid assets, and so that gets us to our total inclusion of $1,500. And again, we have a $77 deduction to get us to our effective rate there. The key point here is that it isn't a pro rata. We don't take our $1,500 and pro ratably allocate it between what's invested in cash and what's invested in illiquid assets. Rather, you take your inclusion and your cash amount, and the lesser of those two is what's subject to tax at the effective rate of 15.5%. And if you have any earnings remaining that are left over, then those are subject to tax at the 8%. So in this case, our overall effective tax rate, and we didn't take into account any foreign tax credits, our overall effective tax rate on this is 14.6%. So the IRS did issue a notice at the end of 2017 with some guidance on how to prevent double counting of cash when specified foreign corporations have differing year ends. The notice also indicated areas where they are going to be issuing some further guidance. At least this is kind of the first pass at it where they see kind of the most relevant issues that need to be addressed right away. In looking at this list and reading through the statute and the conference committee report, there's probably still also a number of other areas that need to be addressed that aren't addressed either in this notice or in those things. So, one of the issues that I see just kind of from a practical standpoint is that the payment is due on April 16th for calendar year taxpayers. It's due on the tax return due date, whether that return is extended or not. But the issue is, if you make that payment and you also extend your return and you include an extension payment, but then when you go to calculate, the actual amount when you file your return, and again, let's say you take all the way up to October 15th, the extended due date, to do that, what if your amount is different than what you estimated? Do you kind of get to reallocate those two payments that you made at April 15th to make sure that you cover your 8% that's due that day? Because the issue is you're allowed to keep your installment payments as long as you pay your full amount of the installment by each of the due dates. If you don't pay the full amount that's due, that accelerates any remaining amounts due. So if I calculate that I owe $100 at April 15th, and I also make an extension payment of $200, so that my total payments are $300, what happens when I get to my tax return and I owe $150 on my 965 calc? Do I get to take $50 for my extension payment? What happens, in that case? So I think, that's kind of a practical issue that I think needs to be addressed, especially before April 16th. The other thing is just how all of this is going to be reported. So, that's another piece that also needs to be considered. So again, all of this on the 965 calculation is to pay for the dividend received deduction. As we note that, this only applies to a C corporation. So in general, dividends from foreign subs are now exempt, provided that certain qualifications are met. The first is that you hold the stock for at least 365 days. You don't have to hold it for 365 days on the date that the dividend is paid, but you can look to kind of your holding period on either side of that date to count the 365 days. You have to hold at least 10% or more of the stock of the distributing corporation. The dividend is not available for a hybrid dividend, and a hybrid dividend is a dividend where the payor is getting a tax benefit or a deduction for the payment in their home country. And finally, the new dividend received deduction will not apply to any dividend from a passive foreign investment company, even if you do meet all of the other requirements. Because that dividend income is now tax exempt, any foreign taxes that have been paid on that income are not available as a credit. So that includes both the foreign taxes that have been paid by that foreign entity in its home country on those earnings, as well as any withholding taxes that may be assessed on that payment of the dividend to the U.S. And then finally, the U.S. has a rule that if stock of a controlled foreign corporation is sold, then the gain on that sale is recharacterized as a dividend to the extent of any accumulated but untaxed earnings of that entity. And because that is treated as a dividend under U.S. tax rules, that gain is also now going to be exempt as long as it's recharacterized as a dividend. So that's also kind of provides an ability to potentially exempt some capital gains on sales of foreign entities.
So Section 1248 still applies. Yeah. Sorry, go ahead.
Yep. And so with that, we get to our first polling question. And with the new law, what is the likelihood that you will repatriate any offshore earnings? Is it more likely now, same as before, or less likely now? And while I give you some time to answer that, I'm going to turn it over to Ken to talk about some of the other changes.
Yes, thank you, Roy. And I think we need to wait a few seconds here for everyone to get their answers in and hit the submit button. But 20 or 30 seconds probably sufficient.
All right.
Okay, and 53% of you say that this will have no effect. So if that's the case, then the government may not be achieving its goal of encouraging repatriations, although 38% sound like they will be repatriating, which will certainly have an effect on the amount of cash that's brought back to the U.S. So with that, I'll move on to the sting in the tail of this entire tax reform. If we just stopped at this point in the slide presentation, corporate America could declare victory and go home, because these tax reforms are something that a lot of people have wanted and are certainly favorable for the corporate America and business generally. But the government is not content to leave it at that. Whereas on the one hand, we now have what is commonly referred to as a territorial tax system, where you're only supposed to be taxed on income that's attributable to your United States business, generally speaking, because of the dividend received deduction. Government has also gone ahead and added on top of the territorial system a worldwide tax system. And that refers to the Global Intangible Low Tax Income provision of Section, it's in Section 250 and 951 Cap A. 951 Cap A is a new section, and it's included in Subpart F, not coincidentally. And not coincidentally, this income is referred to as GILTY. So a lot of people apparently don't like the way that U.S. companies have presumably or supposedly moved intangible rights offshore to achieve a lower tax rate. And those people are, quote, guilty, unquote. And this provision essentially imposes a minimum tax on the intangible income of U.S. multinationals or U.S. Offshore companies, CFCs, and or on their shareholders. So what does this effectively do? A U.S. shareholder's guilty equals the excess of the tested income of all their CFCs. And again, this is CFCs, not specified foreign corporations, as in the previous. So it has to be a CFC, over the net deemed tangible income return for the same year. So in other words, what Congress is getting at is they're going to figure out what your CFC income is, and then they're going to take out of that a net number attributable to what they believe is a decent rate of return on tangible assets. And that difference is subject to tax, albeit at a lower rate. Anyone familiar with U.S. companies knows that the tangible assets don't drive a lot of the value these days, especially on the West Coast. So the net deemed tangible income return is the excess of 10% of the aggregate, and again, this is computed on a shareholder level, of their qualified business investment, or QBI, which is a term you'll probably remember, of each CFC over interest expense netted against it. The net CFC tested income is the excess of the aggregate of the tested income over the aggregate tested loss for each CFC, similar to how the provisions work in the transition tax. So QBI, again, this is what gives rise to the so-called tangible return, qualified business asset investment. It equals the average aggregate adjusted basis for specific tangible property, and essentially this has to be depreciable property, which of course is a bit problematic because again, not every company in America that has CFCs has gigantic factories in other countries. A lot of them have a workforce in place and other intangibles. So this QBI number is likely to be fairly small for a lot of companies, especially on the West Coast. So unless all of your offshore profits and investment is in factories and other fixed and depreciable assets, your QBI number might tend to be low, which means that the difference between your income and your QBI is subject to U.S. tax. So rather than having a territorial system, we're now back on a worldwide system. So there is a little bit of benefit some benefit to corporations because you will get a reduced foreign tax credit that is 80% amount of what is brought in as a result of this inclusion under the quasi-subpart F rules, although your Section 78 gross up will be 100% of the tax of the foreign taxes. And mechanically, the rate of tax that this is subject to, it's not subject to the full new 21% tax rate. It will be subject through 2025 at 50% of the tax rate, or 10.5%. And so if you can offset credits to that amount, what that really means is that if you pay tax in a foreign jurisdiction at 13.125%, you'll have no, theoretically at least, you'll have no residual tax in the U.S. as a result of the inclusion. And 13.1. I'm sorry. Go ahead, Roy. Yes.
That no residual U.S. tax, though, presupposes that a taxpayer can use their foreign tax credits if they're in a loss, or if they have overall foreign losses or something else which prohibits the ability to use all of their foreign tax credits. Then that theory goes a bit out the window.
Oh, that's an excellent point. Now, it's also interesting. I don't think that this is this is a year-by-year computation. So if it comes up and you can't get the tax deduction for it, then you're sort of stuck. I think 13.125 though is one of those numbers. It's kind of like numerology. We'll see it throughout this tax law. 13.125 is, in theory, if you can use credits, the rate at which you won't pay a residual tax on the GILTI. Now, from 2026 and on, this percentage, this haircut, decreases to 37.5%. And that gives rise to an effective tax rate on GILTI of the same number, 13.125. In that situation, the theoretical minimum tax you have to pay in the foreign jurisdiction is 16.4%. So 16.4%. So what we're saying here, I think, is the U.S. is interested in tax avoidance, tax evasion, even reduced taxes in other countries, and they're essentially saying that if you're not paying over 13 or later 16% tax rate in a foreign jurisdiction, they're going to subject you to tax in the U.S. on that difference. One rule: if you have a partnership interest, your QBI is computed, and you're a distributive share of that adjusted aggregate basis in intangible property. And obviously, well, maybe not obviously, but the Treasury Department has authority to issue regulations and other guidance on these rules. So we have a simple, relatively simple example here. You got a U.S. parent. As Roy was commenting, taxable income of, in this case, a $350 loss prior to the QBI. CFC1 has $1 billion or $1 million in essentially gross income, $150 in foreign taxes, and $100 of average asset base. CFC2 has $500 of gross income, $75 of taxes, and no tangible assets at all. Now, according to the computation, the net tested income of this is $1,275, which is essentially the income, the 1,000 plus the 500 minus the $150 or $225 of taxes, and then the GILTI income is that number less that $100 of asset times this deemed return on your tangible asset of 10%, so $1,265. So that $1,265 of GILTI, you then include that in your tax return. It's not really 100 because it's more like 99.2, but we just put 100 here, 99.2%. 100% aggregate taxes of $225. Your deemed paid credit is 80% of the $225, or $180. Your Section 78 gross up is still the full amount of the foreign credit, the $225, or foreign taxes, $225. So your grossed up GILTI is $1,490, which should be $1,265 plus $225. Your domestic taxable loss is $350, so your taxable income is now $1,140. Your deduction for foreign derived intangible profits, or GILTI, at this point is going to be 50% of that, at least through 2025. So your inclusion is $570 at tax rate of 21%. Gives rise to U.S. tax of $120, roughly speaking. Now, in this case, for some reason, we've assumed a lot of foreign tax credits. So in this case, the taxpayer won't pay anything. Now, if the taxpayer was earning a bunch of profit in the Cayman Islands or someplace, then there would be tax due. So again, this just shows you the effect of the minimum tax provisions under GILTI. And with that, we have another question. Is the new GILTI likely to cause you to reevaluate the current structure of your international operations? And we'll give you yes, no, and haven't given it much thought. We'll give you about 20 seconds here to answer the questions and let us know what you think. And this is not too surprising. The yes percentage, 26, is similar to what we had with the other provisions. The no is 33, which is a little less, and then the plurality here haven't given it much thought, and I think that's fair because this rule kicks in 2018, and then everybody's struggling with the other provisions that start in 2017. So this is really subject to a lot of analysis and thought, and essentially whether the minimum tax affects a company or not is going to depend on their asset structure and their intangibles as a percentage of their profit. So,
and Ken, I'm sorry, right? Before you get into that, I mean, we are probably tracking a little bit behind where we wanted to be. So just to make sure that everybody gets or has the opportunity for CPE credits, we'll jump to the next polling question and then come back to the foreign derived intangible income.
Okay, right. Which of the following are you most? I'm sorry. Go ahead.
So with these changes, which one is causing kind of the most discussion or concern within your organization? Is it the transition tax under 965, the GILTI that Ken just talked about, or the base erosion and anti-avoidance tax that we're going to talk about in a little bit? Which one is causing the most concern?
I'll give you a few seconds here.
All right.
Transition tax. And that makes sense because, again, we're dealing with this right now.
Yep.
Not surprising people aren't concerned about BEAT because we haven't talked about it yet.
And we will have one more question at the end, just in case you weren't able to get one of the three that we did, but we wanted to make sure that everyone had that opportunity.
Okay. So, thank you, Roy. So, and again, there's some interesting sort of analogies and parallels in this law, and the flip side of the GILTI is FDII, which is foreign derived intangible income, and that's a deduction. And probably the way to think about this is it's essentially the same type of income that GILTI is, except it's earned domestically. And the other way to think about it is that is sort of son of DISC, son of FISC, son of ETI, and frankly, a provision that is intended as an incentive for U.S. taxpayers to keep their intangibles in the U.S., and which, quite honestly, is probably going to be challenged by the WTO and other organizations, just as those previous provisions were.
But again, when we're talking about U.S. taxpayers, because of the way that the law was written, we're really talking about C corporations.
Fair enough. That's right. Domestic C corporations, because this operates through Section 250, which is essentially the C corporation dividend received deduction, or it's a new code section, but it's in that part of the code, I should say. So for tax years through 2025, same period as for GILTI, a domestic C corporation gets a 37.5% deduction on its foreign-derived intangible income. And the idea here is to get to a 13.125 effective tax rate on that income, which, again, is that magical number that keeps coming up and is, frankly, a pretty low tax rate by almost any standard on corporate income. So it's clearly an incentive. So for the 2026 tax year and on, that rate will rise to 21.825, which would give rise to resulting effective tax rate of 14.4. And of course, it's nice to have this incentive, but if one is a corporation thinking about investing in the future, you also have to wonder how long will these laws be around and whether they will transition as stated, because it wouldn't be very difficult for a future government to just decide that the deduction goes away or that GILTI should be taxed at 100%. So there's a bit of uncertainty, I think, in terms of how quickly the tax landscape is changing. But for now, this is a real incentive. FDI is equal to the deemed intangible income of the C corporation multiplied by the foreign-derived deduction-eligible income over the deduction-eligible income of the corporation. That's probably a little bit too complicated and wordy, but basically the deemed intangible income is similar to GILTI. It's what's called deduction-eligible income over the deemed tangible income return of the corporation. And again, the deemed tangible income is based on a tangible asset number, the QBI, which we talked about before, multiplied by 10%. So you're given a fixed rate of return on your tangible assets, and other income that is deemed intangible can be treated as incentivized if it's foreign source. And when I say foreign source, I mean from a foreign person. It doesn't necessarily have to be foreign source in the 861 sense. Okay. So deduction eligible income is the excess of the corporation's gross income, excluding certain things like GILTI, Subpart F, and other things, over the deductions allocable as such income. And then the foreign-derived deduction-eligible income, and this is the key definition, I think, is any deduction-eligible income which is derived in connection with property sold, leased, licensed, or exchanged to non-U.S. persons for use, consumption, or disposition outside the U.S., or services to any person with respect to any property located outside the U.S. So, it's not a sort of a classic sourcing rule. It's a question of almost where your customer is. And property, obviously, presumably, includes intangible property. So we have an example here that is maybe a bit complicated, but we look at a company that has 500 of U.S. sales, 1,000 of sales to foreign customers. Their so-called deduction eligible revenue is 1,500. Cost of goods sold 300, so their gross profit's 1,200. We've ignored GILTI, Subpart F, other branch income for now. Their allocable deductions are $100. Their deduction eligible income is 1,001, and their QBI, and we're giving this to you as a fact, it's not derived, is $500. The routine return factor on the QBI is 10%. So the routine return on the tangible assets is $50, which gives rise to your deemed intangible income of 1,100 minus 50. As we've noted above, you've got 1,000 of foreign revenue. Two-thirds of that, or that's two-thirds of your gross income or your gross revenue. So you get 66.67% as the ratio, and then you multiply the deemed intangible income times that ratio, and $700 is your foreign-derived intangible income. The deduction factor for that is 37.5%. So out of the $700 of income that we've isolated and deemed to be FDII, the corporation gets a $263 deduction. So your 1,200 goes down to $938. Taxes at 21% rate is $197, and you end up with a pretty low tax rate, 17.9%. So in this fact pattern, clearly we're operating in a much lower income tax environment than would have been the case a year or two ago with respect to this type of income if it had been earned in the U.S. All right. So that's the incentive, and now we have perhaps inspired by the OECD, the government has imposed a new punitive section, Section 59A, Cap A rather. And it's interesting because they took away the alternative minimum tax, and during all the initial discussion of the new tax law, there were lots of things like border adjustment tax and this terrible, to editorialize a bit, excise tax on imported, related party sales and purchases rather, that would have really had an impact on corporations. And what they settled for was a base erosion and anti-abuse tax, which is almost sort of an indirect tax, almost sort of an AMT. It doesn't apply to anybody unless they have $500 million in gross receipts, and but it does apply to companies of that size that have what is called a base erosion percentage of at least 3%, and that base erosion is essentially any payment to a related foreign person for which a deduction is allowable, that with the exception of cost of goods sold property. So it doesn't apply to a related contract manufacturer or related manufacturer making something outside the U.S. It applies, I guess, mainly to service type payments and some other types of payments, such as intangibles, I think, as well. Go ahead. Sorry, Craig.
And a couple of points. One, again, this only applies to C corporations. So while C corporations had benefits under other sections, this is one where they only have the detriment on this. And the other point, too, is that, under kind of prior bills before this one, this final bill, there was some discussion about payments for inventory would get caught up into this calculation. And in the final one, that is not in there. It's only for items where there's a deduction or for the purchase of tangible, depreciable property.
Yeah, that's right. And I think when, after thinking about this, service payments would be caught up in this, but I think what they're really trying to get at here is intangible payments. So they're trying to incentivize people to bring intangibles back to the U.S., and they're going to penalize you for making payments for intangibles to related parties. Although, query, would that payment be subpart F, et cetera? That may not apply. We do have an example. Let me try to skip along here. So BEAT is the applicable tax rate, which we'll get to. It's 5 or 10% usually, times the modified taxable income that's computed. And modified taxable income is the company's taxable income without regard to any base erosion payment or the base erosion percentage of any NOL deduction allowed. And key information here, the BEAT applicable tax rate is 5% just for 2018, and then it goes up to 10% through 2025, and it becomes 12.9% 2026 and onward. So, this can be a real stinger if it keeps going up.
Yeah,
and
the other thing too.
Yeah, go ahead.
I was going to say, if there's a U.S. withholding tax on a payment, right, then you can pro rata reduce your preference item based on the U.S. withholding tax that was paid.
That's right. So the rule works similar to 163J. Now, of course, if we're talking about true service payments, there's probably not going to be a withholding tax. But if you are making a royalty payment, then to the extent that you're making a payment that's subject to a 30% withholding tax, this would not apply to you. And along with the tax, there is new, essentially, I'll just simplify by saying, additional section Form 5472 information will be required to give the service enough information to figure out what your BEAT tax should be. And the penalty for failure to disclose is now going to go up to $25,000 from the $10,000. So they're trying to really incentivize people to provide this information.
Except the 5472 instructions that are available today, even though they look to be updated, has not adjusted for this increase in penalty.
That's right. And I think, I mean, we were at, you and I were both at a tax conference in Washington, D.C., where I don't remember her title, but she was the sort of vice head of international for the IRS, Margie Rollison, basically said, there's just no way we're going to be able to get all these forms ready. So I think taxpayers are going to be in a bit of a quandary until the government gets forms and further guidance ready. In this case, the FIT 472 needs to be updated to provide the necessary information.
All right, and before we get on, again, just to give people the ability to earn CPE, we have a polling question which we didn't get a chance to discuss the underlying provision, but that provision is, just to give you some context as you're thinking through the polling question, is right now certain stock of a foreign corporation that is owned by a foreign person will be attributed to a related U.S. person for purposes of the new, for determining CFC rules. So what this means is that if you are a U.S. corporation and you have a foreign entity as a parent entity, then any other foreign entities owned by that foreign parent, the U.S. company now has to complete a Form 5471 for that. So if you're a U.S. company, part of a large multinational group, that's again with a foreign parent, that compliance burden could be extremely onerous. We are anticipating that some guidance will be issued to alleviate that burden, but until such guidance is issued, there could be significant increase in tax return compliance for beginning with the 2017 tax return. We don't know necessarily if that compliance increase was intended, but as the law was written, and again, this kind of happens when tax law is hastily put together and then left to the Treasury Department to kind of put the pieces together. Until that guidance is issued, that's the position that we're in. So there could be what we feel, some significant changes in compliance for inbound U.S. companies beginning with their 2017 tax return. So with that, we'll look at the results. And yes, so some people will be, feeling the pressure on that.
Yeah, and it's not just due to the attribution rules, of course. There's a lot of other provisions that will
yes.
Cause compliance headaches, and a lot of things that were once theoretical are no longer theoretical.
Yeah. And so with that, we'll kind of wrap up with some of the key takeaways. Again, we didn't get a chance to get to everything that we wanted to discuss just because, again, there is so much that's included in this bill. But, as we discussed, the 965 and the transition tax having effect beginning with the 2017 tax returns. 245 Cap A, the new dividend received deduction, that went into effect 1/1/18. So dividends can come back today, literally today. If you're a C corporation, and you can no longer have to pay the residual U.S. tax on that income. Ken talked about the GILTI and the BEAT. We didn't get a chance to talk about the hybrid arrangements, but again, these are new items that have been put in, a lot of it as part of the implementing the OECD's BEPS program. So those are the types of things that Congress has chosen to have those in place for that purpose. But on the flip side, the incentive, the foreign derived intangible income, again, that exists as of today. But we would anticipate that, like the FISC and like the extraterritorial income exclusion, that there would be a WTO challenge to that. So that may have somewhat of a limited shelf life, but it's the law of the land as it stands today. And then finally, we talked about some additional reporting that may be required. And that's it. And unfortunately, we didn't have a chance to get to questions, but if you did ask a question, we will get back to you shortly. And if you have other questions, here's our contact information. We'd be happy to answer any that you have.
And anybody who wants to call us to walk through the rest of the slide deck or do the beat computation, we'll be happy to talk to you.
All right. Thank you, Roy and Ken, for a great presentation today. We covered a lot of material. If you're interested in downloading the slides from today's presentation, you can do so in the slide deck and handouts widget to the right of the slide view. And as Roy and Ken mentioned, if you asked a question that we didn't have time to answer today, we'll do our best to follow up with you afterwards or reach out directly to Roy or Ken. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts widget to the right of the slide view. And if you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.